With Frank Napolitano and Paul Rushforth, here is Steve Gregory.
Here we go. Last weekend of spring.
Yep.
Wow. Days are going to get shorter. You don't like that, do you, Steve?
No, days are, so the days continue to get longer until Wednesday.
Yeah.
I kind of miss you being on Facebook posting all that stuff, you know? You used to tell us how long the days were every single day. We knew.
That's
Our
one
friend Mike
person.
Herschetto does it now. Our friend
does
Mike
he do it?
Herschetto does it, yeah. Not as often as you did. He doesn't do it first thing every morning, but he does it from time to time.
You must have a life.
Yeah.
Speaking of having a life, good to have you back. We missed you last week. Not really.
Well, you guys, I listened to the show. You didn't throw too many jabs my way, which was nice. But,
No, Dora's always great.
No,
it was
Dora's
nice.
fantastic.
She is fantastic. It was nice. It was nice having a break. And actually, Dora, after the show, sent me a message saying I'd love to do it once a month if I could. And I said, no problem. I'll take a Saturday off for sure.
Oh, don't worry. Steve and I were all for it, too. Don't worry.
Oh, yeah, I'm sure.
Actually, it was our suggestion.
Yeah, it was our suggestion. We're starting at once a month. Eventually, it'll be 4 times a month.
So being
Well,
away-
hey, guess what? Guess what? Then that's one time I don't have to buy breakfast.
Well, see, ladies and gentlemen.
Here we go.
He only mentions it because I've decided I'm never going to mention it when I buy it. So if you ever hear about breakfast, it's Paul bought. So it won't be often. Don't worry about it.
All right, let's get into it.
Yep, there we go.
Oh, there's no retort to that?
No, there's no
nah.
retort because it's true.
You sound like
He
Frank in
can't argue
Vegas. You
that
got nothing
fact.
to say?
No, I just had to call my financial advisor again this morning and tell him I'm buying another breakfast. How do I save more money? What are you going to do with the time and money you save?
I know what I did.
All right, let's get into it.
All right, so we missed you last week, which means you missed talking about the May numbers.
Yep.
And
Did Dora not talk about them?
yeah, she did, absolutely.
Yeah.
But I'm just wondering now, with the rate hike that you also missed, what's happened in this past week? Has it slowed people down a little bit?
I'm going to say it hasn't slowed down our listings. I'll tell you that. I mean, our listings are piling up. You know, we're now into 70, 80 listings on the market right now. So the listings are starting to pile up. I wouldn't say it deflated the market. I would say it kind of flattened the market maybe a little bit. You know, we went from seeing, you know, multiple offers on, let's say 50% of our properties to maybe like 20% of our properties now. I think we've become accustomed to the rate environment right now. I think it's just in people's heads now. Like if they raise
attitude,
it's
right?
attitude. I mean, if they raise it again, which I know Frank believes they will, if they do raise it again, once again, it's like, is a quarter point that much? Yeah, if you have a big mortgage. I mean, I've seen my commercial mortgage go up $3,500 a month just from these rate hikes. So it is preventing some people from buying, and that's the honest truth. Our first-time homebuyer product is getting hurt right now because a lot of first-time homebuyers aren't in the market. It's helping our rental market, though, because there's still tons of rentals on the market, but there's way more renters in the market now. So we are seeing a little bit more of a flat market, and you know what? I'd love to have more of a sample size. I'd like to give it another, because what, the next rate announcement is what?
July
12th? July 12th, yeah. So, you know, we have, what do we have, almost 4 weeks to stomach where we are right now. And I just think it's what's really hurting is a very important segment of our market, which is almost a third of our market, is our first-time homebuyers. It's really, really hurting our first-time homebuyers. It's hurting our first-time homebuyer product, too. You're seeing a lot more townhouses on the market, a lot more condos, a lot more terrace homes. It's really hurting that segment of the market. And it's, you know, if you own a townhome, if you own a condo and you're looking to move up to your next home, you can't because no one's buying your property. So that's the most damaged segment of the market right now is the first-time homebuyer market.
Well, if first-time homeowners weren't there, then investors would be there to scoop up that inventory because that's your typical investment property where you can rent it out and cash flow. But with the interest rates where they are today, they don't even cash flow. So that's why you've eliminated not only the first-time homebuyer, but you've eliminated potential investors who are looking for investment properties. But once they do the math on it, the cash flow is negative $700, $800, $900, and then it doesn't make any sense.
Yeah, we have a decent sized investor business, and we have a lot of investors that buy properties off us, and that is really quiet right now because they know, like Frank said. I mean, you know, I've always said if your investment is not cash flow positive, it's not an investment. Then the rates started to go up, prices started to go up, and I'm like, you know what? If you can be underwater a tiny bit, but you know it's going up in value quick enough that you can build that equity, then it's still a good investment. But when you're behind $600, $700, $800, $900 a month on your cash flow for an investment, there's other investments you can invest in that you know it could get you a better return. Now, saying that, you know, back in the day when you were investing in, let's say, somewhere like a Vanier or something like that, you had a lot more cash flow. Your investment didn't go up as quick, but you had a lot of cash flow. Then you looked at somewhere like, New Ed or the Golden Triangle downtown, and it was hard to be cash flow, but the value of that home went up very quick. That's what we're seeing now. Investors that are getting in right now are not doing it for cash flow. They're doing it for equity accumulation.
And they're investors that have been in the market, right? They're taking advantage of what they've already made.
Oh, for sure. I mean, I'm carrying a bunch of townhomes right now that I own next to nothing on them. My rates are next to nothing on them. So I'm definitely cash flow positive. But if you're buying one right now, paying today's rates and the prices the way they are today, very, very hard to be cash flow positive.
Yeah, I'm guessing investors will take a pause. Even though they've got these properties paid where they ordinarily would roll them into a new property, they're probably taking a bit of a pause now.
They're going to take a pause, and they are taking a pause. Something that potentially is cash flow positive, but you need a lot of cash to buy it, is doors under one roof. So if you're looking at a duplex, a triplex, a fourplex, usually those are cash flow positive, but depending on where you buy,
hard to find.
You need $1 million plus to get one of these properties. So if you don't have the bread to get in the game to hopefully be cash flow positive, you're out of that game too. So what's your other option? A townhome, a terrace home, which are not cash flow positive. So we're seeing a lot of investors saying, you know what, hold off for now.
And what do you need as a down payment on something like that?
20% minimum on a, and there's people that call us and say, wow, why don't we just pretend like we're going to live in it? As like, it's going to be hard for a lender to believe that you're going to move out of your $900,000 4-bedroom home to move into a townhouse with 4 kids and 3 bedrooms. So, it's got to be realistic, and you've got to sign an affidavit.
Easier to stomach these days, though. Yeah, I can see that happening. Yeah,
sure is, right? So, again, lying doesn't work in our industry. It's hard because lenders and default insurers put 2 and 2 together, and they and I've seen declines where it's like, nope, we don't believe you, and we're not moving forward with this file. So, got to be careful. Again, I think what this has done is it's eliminated the amateur investor. So when interest rates were really low, there were a lot of amateur investors out there that really didn't know what they were doing. They didn't know what they're getting themselves into. They didn't know the Landlord Tenancy Act. They didn't know how you could backfire on them if they brought the wrong tenant in. They were just focused on owning real estate and, maybe cash flowing it close to neutral because the interest rates were so low. So,
what happens to these investment properties in 2 years when their mortgages come up?
Well, never mind the investment properties. We're talking about the real estate market in general across our country. Interest rates are high now. I think there's another 0.25% increase based on all the data that I've seen. I don't agree with it. I don't agree with the increase back in 2 weeks ago. U.S. did not increase their prime rate.
They paused, but
they said there's increases on the way. But their inflation number came down nicely this month. So we'll see. Before Canada makes their next announcement, there's a jobs report. There's obviously the inflation report that's coming out in a week and a half, and then there's an economic report that's coming out. And those three will tell us whether Bank of Canada is going to go back on the pause side, or it's going to signal one more increase. But there's probably one more increase left at most, and that's it. So
it's really delayed what's happening to the market. Like last year, I was saying as the rates were coming up, I was saying, by the time we're in summer, if not third or fourth quarter in 2023, our numbers will be back to normal. Well, here we are, summer 2023, and our numbers are going up again.
Well,
right?
We also thought we'd be in a recession right now, too.
Yes, yeah, we did.
We're at the beginning of one.
We are.
There's no question.
Yeah, but we've been at the beginning of a recession for 4 months now.
No question. It's been a delayed reaction to it. I'll tell you that I think, again, some of the people that I talk to that are restaurant owners and business owners, they've started to see the dip. So it's coming. And at some point, we're just going to fall off the cliff. I truly believe that. It is so hard. Listen, I don't understand how – I'm trying to put 2 and 2 together. I understand why food prices were so high for a while, but I don't understand why they're still elevated because diesel's down to $1.50 a liter, and that's what they said was driving the cost of the food up. Well, now that's gone, and yet still the food prices haven't come down.
But the food prices were way out of whack.
Still are.
And still are.
Yeah.
Try to go to a restaurant these days. Like, walking out of a restaurant, if you have, let's say, a drink or 2 drinks and a meal, depending on which restaurant, but it could be $300-$400. It's ridiculous. I was actually talking to a buddy
McDonald's serves drinks now?
McDonald's, you can't go to McDonald's for less than $20.
Oh, McDonald's is expensive,
like,
man.
It used to be $3, $4. You can't go to McDonald's. I took my wife, big spender I am, for anniversary.
To McDonald's?
So McDonald's good for you, Frankie.
No, they're sentimental St. Hubert. We like St. Hubert chicken. So we'll drive by 5 Swiss chalets to go to St. Hubert. That's where we had our first date, and that's where we went for dinner this week for our anniversary. $70.
First date, he took her out for chicken.
Yeah,
Chicken, nice.
$70 for 2 of us to have chicken. No alcoholic beverages, just chicken.
How much was your first date?
Probably $8, $9. That's how much.
Yeah, but that was back in the 30s.
42 years ago. It's 42 years ago.
Did you go Dutch?
Never.
But it is. But I was talking to a buddy the other day who has a really good job, decent salary. He's into the 200 in as a salary, and with the way his mortgage has gone up, he bought just as the rates were going up. He took a variable. Says my mortgage is an extra $400-$500 a month. He goes, I'm living paycheck to paycheck, and that's on a guy making a couple $100,000.
But there's lots of 2-income families that are experiencing the same thing. And listen, they're not lavish, and I say it because they tell me what they do, they show me what they do, and it's like you're not living lavishly, you're living normally. But here they are struggling. If one of them ever got laid off, they'd be in deep trouble. And unfortunately, we're starting to see layoffs. I mean, we saw it here at Bell, but we're seeing it in so many major corporations. And the ones that are laying off, by the way, are the most profitable ones. But anyway, that's another story. But the ones that are really doing well on the profit side are the ones that are laying off, and that's discouraging.
So now if we go into a recession and businesses begin to lay off more people and you lose that double income and mortgages come due, this is like the perfect storm in a couple of years.
Perfect storm is going to hit anyway. In 2025 and 2026, when, again, people were buying at these elevated prices because the market was going crazy. They were getting 1.89%, 2.19% mortgages. If interest rates are where they are today at 5%, you're going to see for sale signs everywhere because they cannot qualify or even afford to live in that house. They're struggling now. And it's not the mortgage. And when people say, wow, they shouldn't have bought that big. It's not the mortgage that's hurting them. It's everything else that's gone up so significantly that's hurting them, not the mortgage payment itself. They were okay with the mortgage payment. They accepted the mortgage payment. They qualified for the mortgage payment because they were qualifying at 5.25%. So they qualified for the mortgage payment. What's hurting everyone today is all the outside noise.
You know, I would be fine if I didn't have to buy breakfast every morning.
Stop it.
Jeez.
You're going to have to start buying smaller coffees.
Yeah, seriously. No more larges. We're going to smalls.
There you go.
I got it. Well, I mean, if you can save and go to St. Hubert, I can save and go from a large to a small.
All right.
For sure.
For 8 times a year, you can buy me a small coffee. I'll still buy you a large. A large, what's it called? Girl tea? No, what do you have?
It's a green tea.
Green tea, that's it. Yeah.
521-TALK, 521-8255. The Happy Threesome will be right back. We're back. Mr. Rushforth, Mr. Napolitano. What's going on with rates here, Frank? You can't get a mortgage for anything less than 5.9 now.
Well, so again, I mean, if you're looking at high ratio, which is less than 20% down on a purchase and less than $1 million, or 35% or more down payment with a 25-year amortization, we've still got a couple of lenders at the 4.94, 4.99, so we're close. But if you're looking at your traditional mortgage, and it sounds crazy, listen, every time I say it, it's like, oh my God, it sounds so crazy. But if you're buying with 20% down, which means you've got more skin in the game, and technically the bank should have less risk, your rate is about 0.5% higher because there's no default insurance involved, and therefore the bank feels they're more at risk without the default insurance than if default insurance was there, which is when you buy with 20% down, or less than 20% down, then the customer pays for the default insurance. What's interesting is that there's non-bank lenders, which, by the way, behind the scenes, I had a client, we got an approval, we got a great rate for her, and she calls back and she goes, I'm just going to stick with my bank even though it's 0.25% more. And because her bank told her that this lender wasn't very good. This lender's been around for 22 years, nothing but positive reviews. But again, she listened to her bank and paid 0.25% more. Congratulations, good for you. You just threw money at the bank. But these non-bank lenders are actually funded by the big banks. Most of the funds they get are from the big banks. Their penalty policies are better, but they offer what's called an insurable mortgage, which is if you have 35% down or more, they actually get the default insurance, but they pay for it. They don't let the customer pay for it. They pay for it, and in return, you get a better rate. So it makes a whole lot more sense to go through a non-bank lender who usually have better prepayment privileges and better penalty policies should you have to break it early, which we see way too much of these days. And
we're going to see more.
The ones that are disheartening to me right now are the ones that are going through a separation or a job loss, and they've got a 1.89% mortgage. We've had a couple of them in the last 3 or 4 months where individually they can't qualify on their own. So now they have to sell their property, and they're giving up a 1.89. And if they're buying a new property, now they can port it, but unfortunately they don't qualify because now they've separated. So
what are you qualifying at today?
Depends on
like if you want a variable, you're over 6.5%. So what are you qualifying?
So if you want a variable again with a high ratio or less than 65%, you can still get prime minus 90, so almost prime minus 1%. So it's 695, so you're 605, and then you add 2 points on top of that, so you're at 805. You're qualifying at 8.05%. If you're applying for a line of credit today, a home equity line of credit, 695 plus most banks are prime plus a half, so you're at 745. You're having to qualify at 9.45%.
Wow.
That's
insanity.
Yeah.
Nobody
today
is going to be fixing up their homes on lines of credit. Right
No one's taking on
it's
a line
wrong
of
time
credit.
to do it anyway. Like, I had a client call me yesterday who happens to be a real estate agent, and she's just going through a scenario in her head where, she bought the family home, and she's renovated it, and she's got some equity in that home, and now she's thinking, maybe my husband and I, because she's got other family members still living in the house, maybe my husband and I will buy ourselves our own townhouse, and, the family can stay there. And I did the math for her, and I said, you're crazy. As a friend, I'm telling you, you're crazy to go forward with this right now. Your total payments on all the mortgages for both properties, the property taxes, the insurance, $10,000 a month. You're crazy. Don't do it. It's just not. There are times to do it, and I think Paul will agree. As much as you're a real estate agent, you still have to do what's best for the client, and sometimes it's not the best time. Like for investment properties, it's not the best time to buy investment properties today because they don't cash flow, and there's no guarantee that the property values. Listen, we're heading into a recession. Generally speaking, Canada does well with the home prices during recessions, but there's no guarantee. Just like generally, Bank of Canada doesn't raise 10 times in a 15-month cycle and raises prime by 4.5 percentage points. Generally speaking, that doesn't happen, but it's happened. So, I think you have to give customers the right advice as to, look at them and say, don't put yourself, in this case, like she's done so well building equity in this property, don't throw it all away just like that. It's okay to be patient and maybe wait 6 months, a year, and wait for these interest rates to normalize again, and then look at doing it.
Yeah, the only problem is we've been saying the interest rates are going to normalize for the last 6, 7, 8 months, right?
I know.
I mean, we actually said it after rate hike 2, 3, 4. We're like, you can't go up again. It's going to come down now.
And he did. That's why I'm saying, like we just don't know. As much as we can follow some of the trends that have happened historically, we're in a new trend right now that we've never seen historically.
Well, they also went up a year earlier than we thought.
Well, a year earlier, and when in essence he saw the inflation numbers going where they were, he should have started 6 months prior because then the increases wouldn't have been as significant. Instead, he waited that extra 6 months, which drove the inflation. And let's call a spade a spade. Our government's not doing us any favors either because they don't stop spending. They continue to start to spend, which is creating inflation numbers even higher.
They're damaging Canadians right now, yet they still spend. They're
and take no responsibility for it.
And they say, oh, it's inflation. Inflation is what's causing this. No, it's your spending is what's causing this. And it's frustrating because I'm seeing so many Canadians that just are struggling so bad. And what do? We just keep raising the interest rates.
Well, and we got to start building more homes.
Well,
home starts were down 70% in May.
Yeah, they're working on that. They're just working on it too slow.
We got 40 million Canadians now, and more coming in every year. We got to do something.
A couple 100 million coming, But it's you're right. You're right. To get a shovel in the ground, I have friends who are builders. And to get a shovel in the ground, the red tape that they go through, sometimes it's like, they asked me one time, they're like, where's this property located? Is it considered City of Ottawa or outside City of Ottawa? Outside City of Ottawa. Perfect. So much easier to get a shovel in the ground. If you're in the City of Ottawa, get a shovel in the ground is so hard, even for the big major builders like the Mintos and the Madamies.
But what are these loan rates doing to builders? That's got to be slowing them down, too. It costs them so much money now.
Builders? How about car dealers? You go into a car dealer right now, I went into a car dealer the other day, and I said, we're looking for this car. She said, yep, no problem. And you're probably looking at November. And I look at the lot, and there's no cars on the lot. And I just said to her, how are you feeding your family? Like, you can't sell anything, you know? And a good buddy of mine, he's a sales manager at a major dealership, same thing. He goes, I'm selling big trucks. I got one.
Yeah.
One. It's just, I don't know how they're surviving, you know? Mainly because of interest rates. I mean,
but with interest rates where they are, if builders aren't going to build because it's too expensive, we're in a catch-22. We need more homes.
Yeah.
They can't afford to build more homes.
Keep in mind, though, there's a lot of builders in Ottawa with deep pockets, right? With deep pockets, and they will build on spec. But there's a lot of builders that won't. I mean, you know, remember back in the day, you'd walk into a Minto subdivision and there'd be like 50, 60 homes that are built waiting for people to buy. Well, that doesn't happen anymore. You don't start building anymore until they're actually sold. And, you know, if they want to let's say it's a townhome and they're going to do a whole phase of townhomes, there's a couple that aren't bought yet. They wait until those ones are bought to get the shovel in the ground. So they're delayed. And then by the time they get everything ready to go, the city delays them even more. So, I mean, we need some great news. I saw that in Orleans, they're building 3 major towers with commercial on the bottom. And I think it's like 1,100 residential units, which is perfect. So we need more things like that. We need a lot more high density homes and builders like that. So,
well, thank God you ended on a high note with great news. We needed it.
hey,
great news. Listen, if you've been a homeowner for the last 5 years, as much as the interest rates are not very good right now, you've built up way more equity than you ever imagined you would.
Oh,
yeah. Yeah. And if you're upset about where your house is valued right now, if we went through a normal Ottawa increase over the last 5 years, your house would never be where it is right now. So just not even close. So just be happy where your house is. Have we come down? Yes. Are we on our way up? Yes. So just be happy where you are.
521-TALK, 521-8255. We'll be right back.
You know, Steve, Frank, I just wanted to apologize for the last half of that segment. You know, I was a little thrown off a little bit. It's not every day that you've been on the show for 16 years and your office manager, Angie White, who's been with you for 12 of those years, calls you right in the middle of your show. So.
Well, like I said, I think she probably thought the same thing as you did this morning, that the show was still at 10 o'clock. That's why you showed up early and bought breakfast. But anyway, let's move on.
I like to be here early to prep, you know, and get ready and get in my game and, you know, get my mojo going and then, you know, obviously buy breakfast.
Angie, I'm not surprised. I don't blame you for not listening.
She's listening right now. I think it's her first show she's ever listened to.
Rick is sure listening. Let's go to the phone and say hello to Rick in Ottawa. Hi, Rick.
Hey, fellas. How are you?
Great.
Well, thanks.
Steve, that was a great segue into this next question. This question is for the real expert here, Frank.
Uh-oh.
By the way, it's Rick LeMay.
Hey, Rick.
Yes. So,
did you just say that? Paul's not happy right now.
So my real question, and it's actually a legitimate one. So we bought a lot. We bought it cash.
Yep.
We are looking at putting shovel in the ground in spring.
Yep.
So we have a lot paid for. We're obviously going to get a construction loan because I'm keeping my house until the very end.
Yep. Rick must be in a bad area because he just cut out.
Apparently, he just got turned down for that loan.
Do we get a construction loan and use up the construction loan before we tap into the liquid cash we have, or do we use all our liquid cash and then into the loan?
Well, I think obviously if you've got liquid cash, you're probably not getting a great return on that liquid cash, I would say. And, you know, I'm sure, you know, if you haven't gone through it before, building a house, there's a lot of cash up front, payments up front. When you're ordering your kitchen, you're giving a huge deposit, yet you're not getting that kitchen for 2, 3, 4 months, but you've already put out a whole bunch of money. Same thing with some of the tradespeople, depending on who's building your house for you. Some of them want some pretty hefty deposits. So, I mean, you want to keep some cash to the side. You always want to have cash as a backup, but you also want to set up. So the first thing that I would do is I would say to you, the first thing we want to do is keep your costs down as much as possible, because building the house itself, your budget will probably we always try to budget for 10% overrun because there's going to be extra cost. But the first step I would say is your liquid cash. And the second step, if you've got equity in your current home, I would tap into that equity as much as possible, or at least set it up so you got access to that equity, because that's much cheaper than a construction mortgage is. So the construction mortgage is the most expensive of all the financing options. So you want to tap into the other ones before you get into that one. You can also borrow against the land. So depending on the land value and where it is, you can get anywhere between 50 to 80% of the land value as well. And again, that's a cheaper way to borrow than the construction mortgage itself, because the construction mortgage also comes with a 10% lien holdback. So every single draw within that construction mortgage, they're going to hold back 10%. It sits at the lawyers. You actually pay interest on that money, and it only gets released 45 days after you've completed the house. So it protects anybody that's doing work on your house. If they don't get paid, they can put a lien on that, and they use that money to pay off those liens.
What about a private mortgage?
Private mortgages are very expensive. Again, I mean, we try. The first step is always to understand someone's finances. When they're going into building a house, I can tell you that I get calls from people that want to buy a lot with 5% down and then have no money to build and think they can do it, and it doesn't work. You just can't do it. You have to have money up front to build a home. A lender's not going to give you money for your permits. That's not the way it works. A lender's not going to give you money for some work that might happen a week or two from now. That's not the way it works. So, in your case, having the lot paid, fantastic. If you've got equity in your current home, I think we want to tap into that equity as much as possible. So you've got that as a line of credit. What's really nice about having a line of credit is the fact that you only pay for the money as you use it. So you would start off with your liquid cash and then get to a point where you need that. Like for some people, they always want to have $20,000, $30,000 available. So once you get to that level, then all of a sudden you could start tapping into the line of credit. And if we can get through with the line of credit as far as we can, then we can tap into the construction mortgage after that.
So the short answer is a line of credit.
No, a construction mortgage might be needed. You may not have enough within your liquid cash and line of credit to be able to build a whole house. But at least if we can get to 50, 60, 70% of it with that, then we're minimizing the construction mortgage, which is the best way to go.
And Rick, when you do go to sell, who would you be using to sell your house?
Call Rushforth.com.
So if anyone doesn't know Rick, this is my good buddy Rick LeMay, also known as Mr. Shoe Beer at the Red Blacks games.
Ah, yes.
Yes, and Rick, did you drink a beer out of shoe this time?
Absolutely. We have to get the fans Blacks on the field that's doing that.
Now, did you start doing that when they started losing their home games? Because if that's the case, stop doing it.
Yeah, he's been doing it for years. Yeah.
I've been doing it.
Or when they get a touchdown, because then you never drink from the shoe if you're relying on them getting a touchdown.
Yeah. My first one was 2007, so it's been a tradition for a long, long, long time.
Oh, okay. Yeah. So you're not the jinx then, all right.
Yeah, all right.
Clearly, you would never do it out of Paul's shoe. Drink out of Paul's shoe. I wouldn't.
Thank you, Rick.
Thanks, Rick. See you, buddy.
Well, nice. Have a good day, guys.
Thanks, Rick.
How much is a construction mortgage?
Again,
percentage?
every lender is different. Some lenders, credit unions, have become more adept to construction mortgages because their costs are significantly less than the big banks. Honestly, the big banks don't want to do a construction mortgage. The big banks don't have the expertise inside their branches to be able to handle a construction mortgage. So, the way they price it, the way they act towards it, it's almost like they're telling us, don't send it to us because we really don't want to do it. But credit unions have got an appetite for them because that's building their client base. And what's really nice about some of the credit unions, they actually fund it internally where you don't even have to go to the lawyer to get the draws, which saves you a little bit of money because every time the money goes to the lawyer and then the lawyer gives it to you, it creates a cost for you. So it's interesting. But again, they have specific tiers in place too, and specific, goals that you need to qualify with, and sometimes they don't work. And then there's, if you're building your own home and you don't have a lot of cash up front to do it, you still need to get enough cash to get to certain stages. But if you don't qualify under the credit union guidelines, then there's private mortgages. They're the most expensive. Most private mortgages run about 9.99 to 10.99%. which is high, but
not as high as it used to be compared to where we are now.
Exactly. But you're only borrowing based on the money. You're only paying interest based on when you borrow the money. So, if you were borrowing $800,000 to build a house and you say it's 10%, it's going to cost me $80,000. Well, no, it won't, because you're not borrowing. You're not getting that $800,000 up front. You're getting it in pieces. So you're only, the 10% is an annual rate. So therefore, it might only cost you $30,000 or $40,000 to borrow that money, depending on when you borrow and how quick you finish your home.
You know what I would do? I would just go to Paul and have him find the exact type of house that I want to build.
Perfect.
Already built. Paul, go find it for me. Done.
You know, there are some builders nowadays that actually build it on their dime, eh? Like what they'll do is, like, for example, someone in Rick's spot, they'll actually take over the lot, build the house on their dime, and then you get a mortgage on closing. If you ever default on it, they take your house because they got it's their land now. But there's some builders that will do that. I know the builders that I used to work with and I still work with will do that for you. So
even today, with rates being what they are.
Even today,
that's the key, though, right? Today. So I had a builder call me and say, Frank, like I want to do construction mortgages for clients that are buying my lots. I'm going to build a house for them, but the client needs to get the mortgage. And I said to them, but if you own the lot, I can't do a construction mortgage for the client because they don't own the property. You have to transfer the property to the client too. He goes, but what if something goes wrong? I said, but that's the risk you're taking. You can't expect me or a lender to give money to a client to build a house that's not in their name until it's completed. Yeah. Like, that's not the way it works. So again, this is a smaller builder who's trying to get a name for himself and trying to get going, but and he doesn't have the financial resources to build a house on his own. So I said, you have to sell the land, maybe do a VTB on the land so that, you're protected that way. But the client needs money. Like, if you're going to get a client that's going to come in and say, all I have is $10,000 or $20,000 deposit, then you got to front the whole thing. That's the only way it's going to work, because there's no way that anybody's going to give the client money to build a house with only $20,000 of, in it for them. So.
That's why the sale of lots right now are a bit of a struggle, right? Because you can buy a lot, but then what do you do with it, right? How's the building?
And land isn't cheap.
Land isn't cheap, but how's the building process? What am I going to get a construction loan? How am I going to get it done? So it's hard to build a home. You need to work with someone who's really experienced at that, for sure.
Yeah, I did it once, and
it's stressful.
It was a pretty stressful circumstance, and the 10% you're talking about, factor in. I would say factor in more than that, because
it's always going to be more.
You're going,
especially today with costs going up and down of everything, and labor going up and down, and then relying on labor.
And then the changes you want to make as you see things unfold in front of you. It's like, oh, you know what? This needs to be a bit bigger.
And my buddy Rick, who just called in, he thinks it's going to be 10% over, but I know his girlfriend, it's going to be 20% over. Chris is going to change everything on him.
521 Talk 521-8255. We'll be right back. Welcome back. Well, we crossed the 40 million mark yesterday.
Wow, what a milestone, eh?
40 million people in Canada.
13 years to go from 30 million to 40 million. It's incredible.
97 we were at 30 million.
2010 we were at 30 million. We got to
97.
No, I thought it was less.
67 we were at 20 million. 97 we were at 30 million.
So now that foreign buyers can't buy here, we basically have 40 million people we could possibly
sell.
Assuming
even the babies can buy.
Even the babies can buy. Yeah.
No, you know what I mean? We still have a supply issue here. I mean, let's call a spade a spade. The only reason it hasn't come to the forefront anymore is because the interest rates have gone up the way they are, and less Canadians can afford to buy a house, because Canadians want to buy homes. They want to be in home ownership. They just can't.
Yeah, but if people aren't buying homes and they're staying in rentals, then we're going to have a rental shortage.
Once you get in that, once you get in that rental trap too, it's really hard to get out, especially with the way rentals are going. I mean, a townhouse in suburbia is, a decent sized one is $2,600, sometimes even more per month. Plus, you got all your utilities on top of that. We're actually starting to see homes actually hit the market now. Now, I don't know if it's a combination. We've seen a spike since that rate announcement went up. We're almost at 3,500 listings on the market right now, where we've been around 30.
Yeah, that's the highest we've been in a while.
That's the highest we've been in a while. So, I mean, it's good to see some of that inventory pick up, but we did notice that the number of sales actually dropped a little bit last week, slightly dropped. So I don't know if it's people aren't buying these yet, or if they're just more homes are hitting the market. Everyone thinks a spring market starts in, April, May. Usually our spring market starts in January and February. This market was a little bit delayed. So I think people are a little bit delayed getting their home on the market. So you might see more sales and more listings in June, July, and August this year. Usually here in Ottawa, I'm sure anywhere where there's snow, it's the winter months are usually hit or miss, right? If we, especially going through COVID when we were cooped up for so long, people wanted to vacation in the summertime. So the market was kind of really slow at that time because most people were away on vacation or at cottage country or camping or something like that. Now that we've had a taste of getting out of those lockdowns and that, it's hard to tell what this summer is going to be like. Is it going to be robust? Is the activity going to be good? Is it going to be slow? Are people still in that vacation mode? It's a double whammy. We had COVID that we couldn't go anywhere and go outside and vacation and all that. But The other thing we have is our climate. Our climate's terrible, right? So it's hard to say. I mean, even with my realtors, I mean, there's some weeks in the summer that I'm like, is there anybody around working for clients because everyone's on vacation? But how do you tell someone who's been cooped up in snow for so long that you can't go on vacation?
Do you think that people are savvy enough now that they are going to wait until the July announcement before they decide if they're going to buy this summer?
Well, they could, but here's another thing. If you are going to buy and you think it's going to go up a quarter point, which Frank thinks so, a lot of mortgage brokers think it's going to go up, would you not want to get something before the rate went up? Another
But then I would ask you the other question. If it's going to go up, then there will be fewer buyers, which might bring the price down. Maybe it is worthwhile waiting.
And
it's the unknown.
It's the unknown, but absolutely. You don't know what's going to happen, and we don't know. Our price is going to come down a little bit. We've seen since January, our average sale price in Ottawa in January was $612,000. We're now, at the end of May, we're up to $655,000. So we're starting... Yes, 655. So we're starting to see that increase from January on. Now, keep in mind, from the end of the year at 691 to the end of January at 612, we had a pretty decent drop. We're now making our rebound. And there are some economists who think that we're going to be up 2%, 4%. But keep in mind, that's 2% and 4% off 691. We're only at 655 right now. So if that holds true, if that comes true, we have a lot of ground to make up, which means we're going to have some, I think, a pretty busy summer months. Our May, personally as a company, we were one of our better months, which is awesome, especially after seeing Jan, Feb, March, and April being so sluggish. Yeah. So I think we might see, we are seeing a delayed spring, and we might see a strong summer, regardless of the rate announcement, is my opinion.
What's happening with days on market now?
Days on market are coming back down. I don't even have that stat in front of me. Well, I do have it. It's in that pile. But yeah, days on market are starting to come down, which is good. So we're creeping down days on market. Over the last week, I think we lost a little bit of optimism in the market. So interesting to see where we're going to be, let's say 2 Saturdays from now on the radio, whether people are going to be back buying, whether people are going to be still sitting on the sidelines, what people are going to be doing. But truthfully, I mean, I think most economists were wrong when they said that, second quarter, maybe third quarter, we're going to start seeing the rates coming back down to normal, which we didn't see. So now what is it? Is it Q1 2024? Is it Q2 2024 that we're going to start seeing those rate decreases?
And do you believe them anyway?
And do you believe them? Yeah.
Right. So I had a client write me and say, Frank, should I stay in the variable? My bank is offering me this for a fixed. And I said, I don't know. I mean, we've pretty well peaked. You may want to write out the variable for now, but it's up to you, your financial position. And then he sends me this article from this economist who says that there might be another one. I said, but this is the same economist who 5 months ago said, we're pausing and we're not going up anymore. So again, be careful what you read. And it's an ever-changing world we live in where the bond markets have spiked since the Bank of Canada announcement. And they're really not going to – now, they slowed down this week finally, but we're not going to know until probably over the next 2 weeks we're going to have a better idea of what Bank of Canada is going to do. But the Feds – so I tell you, the economists in the U.S., so I saw 3 or 4 of them this week that posted, the Feds paused. There's still 1 or 2 more hikes in 2023, and then they believe that prime rate will come down by 1% in 2024 – throughout the year, most of it in the second half of 2024, and by 1.5% in 2025, because they think that they will be in a full-blown recession by middle of next year.
So are you getting a 2 to 3 year mortgage then?
Well, the problem with the 2-3 year mortgage, and that's the conversations that I have with clients all the time, is common sense would dictate, yeah, let's get a 1 or 2 year mortgage, except for the 1 and the 2 year bond markets are inverted, where the 1 and the 2 year are the most expensive mortgages that are out there. You're almost better off to be in a variable than you are in a 1 or 2 year mortgage, because at least the variable allows you to convert it to a fixed anytime, where the 1 or 2 year, you got to ride the whole thing out.
Yeah.
So it's tough.
Yeah, no kidding.
It's
but most
tough.
Canadians are going for a shorter term. They're not going the 5 years right now.
No, that's not true, because, again, you're being tempted by a 5 year at 4.99 versus a 1 or 2 year at 6.25, 6.5. So your initial thinking is, I'm saving way too much money by taking a 5 year. Now they're not thinking about 2 or 3 or 4 years down the road. They're thinking about today, because they may be struggling to make ends meet, and they're trying to keep that payment as low as possible.
Most buyers that we're working with right now, when we ask, have you been pre-approved? And almost, I'd say 90% of the people we're talking to have been pre-approved, and they've been told to take the 5 year fixed.
You know why? Because they don't qualify if it's high. So if you're getting a 1 year at 6.25, you got to qualify at 8.25.
Yeah.
If you're getting a 5-year at 4.99, you got to qualify at 6.99. Potentially, you qualify at the 6.99, but not the 8.25. So you're forced to take the 5-year. So it's again, it's not pleasant, but nonetheless, I think we'll get through this phase. We just got to be patient, and I'd love to share your optimism where I think the market's going to heat up, but I don't. I believe we're in for another 3, 4, 5, 6 months of just shaky market, and then once interest rates start to retract, that's when we'll see everybody get off the fence.
You guys are no good at all. You're worse than economists. I don't know what.
But the truth is, we're not economists. We're just looking at what's happening in our world, and we're predicting. Economists get paid. That's all they do is read that stuff, and they're wrong.
We're realists, and we're just telling what we think is going to happen. But honestly, because of what's gone on with COVID, you can ask me what's going to happen. My answer is I don't know. It's a whole new world. We don't know.
Remember, we thought it was going to be a V. It didn't end up being a V. It ended up being a check mark.
It was
like it went
I
way out of
I believe I said it was going to be a V,
but it wasn't a V. But it wasn't a V because we didn't get back to where we were.
You guys argue the rest of the week.
We went way higher. So.
Birthdays, right?
Yeah, I got a couple. Tammy Graveline, who joined us from Scotiabank just a few weeks ago, celebrating her birthday. My favorite father-in-law, Carmelo, celebrating his birthday on first day of summer.
Are you going to take him to St. Hubert?
No, McDonald's. Shannon Parker, great family friend, celebrating her birthday. And I'm blessed to be going to one of our family friends, Joe Ranieri and Maria. Their son Marco is getting married today, so I'll be back in the Byward Market in a couple of hours for their wedding. And congratulations to Marco and Rhea, and of course to everybody in the room here and to everybody listening. Happy Father's Day tomorrow.
Happy Father's Day. I have one, a longtime loyal listener, Connor, who calls in all the time, but still doesn't use me as his real estate agent.
Hard to believe.
Yes.
I wouldn't even mention his name.
Yeah, well, this is what he turns 33 on Wednesday, but this is what he wrote to me yesterday. It's my birthday on Wednesday. I'll be 33. I expect an announcement or I'll stop listening to your show. I responded and I said, who do you think loses if you stop listening to my show, you or me?
And yet he wishes him a happy birthday. I guess we got the answer to that question. Have a good week, gentlemen.
And support local businesses and charities.
Happy Father's Day.